Good afternoon, everyone. My name is Jennifer Nelson, and on behalf of Educational Community Alliance Credit Union, I would like to welcome you to today's Lunch and Learn presentation on credit. Todd Moore from Trinity Credit will be discussing the topic of credit today. To help you learn how does credit work, how to improve your score, and what Educational Community Alliance can do to help. This presentation will be recorded and available for viewing on our website in the future as well. If you have any questions during the presentation, feel free to use the chat feature, which I will be monitoring. Todd, you can go ahead and share your screen. The floor is yours.
Thank you so much. Let me get things in order here for us. We okay on that end, Jennifer?
We are.
Okay, great. Well, thank you so much, everyone. Thank you for joining us. Let me see if I can put this in slideshow mode. Are we okay? Okay. Appreciate being asked back and great to join everyone this afternoon. Got a lot of material to run through today about improving your credit score. So I'm with Trinity Debt Management. We are a partner with the credit union. And as we move through the presentation, ask any questions in the chat function, or if you have any questions you'd like to ask me after the presentation, you can always get a hold of me here at Trinity Debt Management. Okay, so before we get started, I wanted to just kind of set the tone for today's presentation. When we think about the post-COVID world that we've lived in over the last couple of years, and the amounts of debts that many families now are carrying, we know that credit, it's an incredibly important function, and there's so much work that we need to do. Looking at some of the numbers here, we know that just on average, credit scores, on average, we know that folks are just carrying more and more debt. We've had record credit card debt over the years. You think about the context of COVID-19, folks using their credit cards as a form of maybe supplemental income. Many folks that are transitioning back into the student loan program and just having a money crunch with inflation. So we know that the debts have continued to rise. That's had an impact on credit scoring overall. And, one of the things we're going to do today is just kind of walk you through some of the ways to improve credit. What is scoring, depending on where you're at and what your particular situation is. My goal is that you will be able to use this model long after the call. So let's just jump in now. When we think about credit and credit scoring, one of the things I want us to think about is this concept of segmentation. So this is where, when we're building credit scoring or credit models, this concept of segmentation means that wherever your score is at, between that 300 to 850 model that we're talking about today, you're going to be part of some credit score segment. That is, you're part of the scoring structure. And it becomes very important because the higher the score, the less the risk. And the lower the score, the more the risk. So we have this function of segmentation, and how that functions is that we are always looking to improve our capacity. So when credit scoring is done, we know that it has a tremendous impact on a whole range of things, not just you asking for a loan, but insurance coverage, types of auto loans, credit cards that you're offered, and different parts of the market that will be open to you if you have a stronger score. Those of us who are working to improve our score, we're going to get you there. But segmentation is very important, because what we're looking to do is, when we pull a credit score, we're part of this overall large database that we're pulling from the 3 credit bureaus. It places us somewhere within that large array of scores. And we always are looking to find ways to improve our capacity. So that's the model that I'll be talking about today. The practical application of this idea of where we fit within the market, or where we're segmented, you can see that early on, really, we didn't have consistent credit models. We had small lines of credit that were really extended kind of on a small basis. As time moves forward, we get into regional credit bureaus and then the national credit bureaus that we have, segmentation and risk modeling becomes all the more important. And this is just an important context to understand what scoring is really all about. So as you go through the presentation today, just kind of think about segmentation as a way to differentiate your score within the market. And its most practical application here is just seeing how it's evolved through time. We're at the point now with the national credit bureaus that among the models, and we'll see some of those today, things are automated, but segmentation still is very important when we think about credit scoring. So we also know that there's a great deal of predictive value to credit scoring. And we're going to be looking at the FICO model that runs really from 300 to 850. There are many models in terms of credit scoring, but we're looking at a model today that will be running from 300 to 850. And I've kind of given you just, some ways to think about this in terms of risk. So, obviously 700 plus is where we're aiming. We want to get as high into that model as we can. If you're lower on the model, the reason credit scoring is so important is we want to figure out ways to use a scoring model just to improve ourselves over this next year. That's one of the great things the credit union is doing now, is having a webinar series where we can engage in these topics, learn more about it, kind of grow through time. So if you look here at the slide, it kind of places on kind of a scoring range from 4 all the way into the highest ranges, 800 and above. So depending on where you're at, there'll be a lot of information today that you can use regardless of which one of those tiers you're currently in. And the goal is to kind of figure out, how does that model function and what do I do to improve my score? We'll be talking a lot about that. Service lines of credit. When we think about scoring, really what we're looking at is what we call revolving or installment lines of credit. So revolving is in the credit card market, okay? These are a whole range of different credit card options, what we refer to as revolving line of credit. And you'll see this on a credit report as well. So if you pull a credit report, you see an R listed on your credit report, indicates a revolving or a credit card type of loan. Installment lines of credit, differentiated there by these consistent monthly payments through time. You'll see these things listed on the credit report as well. Service lines of credit. Credit scoring doesn't necessarily apply in service lines, so like a utility or a cable bill, those sorts of things. The two main lines that we're talking about here are what we refer to as revolving or installment lines. Those are going to have the most immediate impact on you of being able to obtain future lines of credit. And those are the ones that we just need to be able to kind of function in middle-class life. We need a car, we need a home, we have to have some line of credit. So these types will have an immediate impact on the ability for you to improve your score through time. Revolving installment, you'll see the application of how that model works. So what I thought I would do is break this down into a couple different scenarios. So we may have some folks who are looking, thinking about improving your score, kind of giving you some of that kind of theoretical stuff up front, because now we're going to apply this as we move forward. When we think about building credit, I also wanted to include something here for maybe young adults. I know that there may be folks on the call where they want to do something to improve credit for someone who maybe is going off into school, maybe in the fall, or thinking about ways to just improve capacity for someone in the family, just build them some credit through time. Now, the credit union offers a whole range of products and services that will help you. Wanted to highlight a couple of those for you now. One would be a secured credit line. So this is where you would put up cash as collateral, and then the credit union would extend a loan to you up to that amount. And then there's also the credit builder loan. Now, different banks and credit unions offer these types of services, but at Educational Community Credit Union, I think it's somewhere around the $500 range with the credit builder loan. And this is a great way to build credit for young folks, or if you're in the situation where you're rebuilding your score, either a secured or a credit builder loan is a fantastic tool to use because both, while small dollar, they can be manageable, and it can also help improve your payment history and to strengthen your score. If you have questions about that, certainly put that in the chat or share those questions with me as we go forward. But those two products, very simple, but significant. Now, thinking about just your, differentiating folks, we talked about segmentation. So one part of segmentation might be young adults with very limited capacity. Another part might be what we refer to, if we were to segment or place within tiers in terms of credit scoring, we might refer to that as a thin file. Okay, so this is where a thin file is just limited credit history. So if we had someone on the call or have someone with us today that we might refer to as a thin file, we know we have a lot of room to strengthen your overall score. So what is a thin file? In this case, what we're talking about, you just lack credit history. Sometimes this refers to folks who may not have had a line. Maybe you've had a bankruptcy or something where you just had a job loss, didn't use credit for a long time. Things have kind of fallen off a credit report. That may be referred to as a thin file. So you have limited accounts that are active and open. So our goal, if you fall into that situation, is to build some credit. So we just have to find ways or find tools to move you from thin file into having a broader or stronger overall credit profile. So in a similar way, I'm going to highlight a couple of things here at the credit union again. Thinking about segmentation, once again, thin file means that we need to have some capacity. We have to find some way to grow. Secured card or a credit builder line is a fantastic way to do that. Again, it's manageable, smaller dollar, somewhere around $500. And what this does is it allows you to have an active open line of credit and have that reported to the credit bureau every month as payment history. And when we get into scoring, you're going to see where payment history becomes our number one factor in our score. So if you're in that thin file category, these two tools or products or services that we offer through the credit union, fantastic and a great way to do this. Very simple in terms of building your overall credit score. Okay. So I've listed some other things in here that do come with higher risk, what we call piggybacking or becoming an authorized user. This is kind of a strategy that is used. So let's say that you are a thin file and perhaps it's a husband and wife or a couple. One has a stronger credit profile, the other one doesn't. You can become an authorized user. You can piggyback off of someone else's stronger credit score or higher capacity, which will improve your score. These types of strategies, we don't have a whole lot of time to get into them and how they function. I'd certainly love to talk about that with you, but we just don't have time to get into that detail. But if you do have questions about that, we definitely want to make sure that you can ask us questions throughout the presentation if that is something that you want to get into later. Okay. The next thing we get into is these are folks now, we talked about, younger adults, kind of thin file. We're also going to talk here about those who just maybe need to enhance or strengthen their overall capacity. So you're not a low score, you're looking to improve your overall capacity. Maybe you've had some loans. You want to do more to strengthen your score through time. So first thing we want to do is figure out what are our goals. What are our credit goals at this point? Is it a car? Are you looking for a personal line, a home? What is the larger credit goal? What product or services what do you need for us to do to help you accomplish that goal? So, if it's just looking to improve your capacity, first thing we want to do is get a baseline read on your score. We can pull that credit report for you here at the office at Trinity. We'll work directly with the credit union to strengthen your capacity and make certain that you get that type of loan that you need. So each one of those products are going to help you in terms of, whether a secured line, something like that, if you're thin file and need some work in this area, or maybe your score is just kind of borderline where you just need, you're 10 points shy or just a little shy from where you need to go. You can definitely do that and build and align a strategy to help you get the loan that you need. So first step though is just figuring out what is your current score, And then let's figure out what it is that you're aiming to achieve. And that puts us into action. So I've listed here a couple things about just understanding more about the scoring process itself. Now, in the next coming slides, we're going to start to get into the actual credit model itself, the factors that go into the score, and then, answering this larger question, why is my credit score X, whatever your score may be. I'm going to present two variations on this model, and I think it'll help you save time. It's much more efficient for you to know these two approaches and why they matter so much for improving your score. But the larger question that we're going to be looking at here soon is, why is my credit score X? That's the factors. What factors are most affected right now that's keeping my score a little lower? What can I do to change things within those factors to get the most efficiency and strongest outcome for my overall credit score? Here's what I'm talking about: the difference between what we look at in terms of some of the FICO models and the Vantage score. Okay. So when we think about a Vantage score itself, the Vantage score is largely used for education purposes. And I've talked about it here as having kind of a 30-point swing one way or the other. The problem with this approach is that if you're using Credit Karma and some of these tools, you're not going to have an accurate read. Here's what I'm really trying to say. Vantage score is not used for lending purposes. I want to caution against saying accurate or inaccurate. It's accurate for what it does, but it's not. What you find. Let's say you're pursuing a home loan or car loan or even a credit card. You find a pretty wide swing, and I've studied this for years and watched this in practice. We know first and foremost that the Vantage score is not used for lending purposes, so we want to rely on the three major credit bureaus. Those are the ones that are going to produce the risk models that we need to make lending decisions. So if you walked into the credit union today, they're not using a Vantage score. They're going to pull from the three major bureaus. To save yourself in time and just pull from the three bureaus as opposed to looking at the Vantage score or making assumptions about your score used solely on the Vantage score itself. And then here's where we get into the 5 factors that I talked about earlier, answering that larger question: why is my credit score X? So here what we're looking at is basically 5 factors that make up your score. So if you think, okay, my score right now is a 685, okay, 685. Got a little work to do. So what's being affected? Why is my credit score X, 685? We look at those 5 factors. We look at payment history, outstanding debts, credit history, inquiries, and types of credit. So what we're trying to do is, again, have some predictive value to figure out what is it that I can do within this model to strengthen my capacity. So payment history, the number 1 factor in our score, this is the one that we think about this in terms of just making payments on time. That's certainly part of it. Consistent payment history is very, very important, that it's on time. One late payment can really throw your score off by about 20 points. It takes several months for that score to come back around. So we always want to be on time. And then, if we think about some of the things that have happened, in the last couple of years, whether it's a civil judgment or a garnishment, all that activity leading up to that really affects payment history. So you're consistently late. That significantly lowers or just creates a negative payment history, drops your score. Okay. But most of us, we think about payment history in terms of it just being on time or delinquent, but it's actually much broader than that. So if you look at your score itself and you want to figure this out, if you've been consistently late or you had anything else happen to you, kind of worst case scenario where something has gone to collections or something like that, the activity leading up to that has had a tremendous impact on your score. Outstanding debts, the way I think about this here is we're looking at whether or not FICO would tell us that the rule is not to carry beyond 30% of your available credit line. So of your total credit line. So you can take any credit card that you have times 0.30, 30%. As you move out beyond that 30%, you can start to see that it shifts your credit debt ratio. It starts to bring down your score. Okay. So we always want to make certain that we monitor the amount that we're carrying. And if we do have debts, we're always looking to bring that back down below 30% and then pay off. So outstanding debts, what we're looking at here is the credit debt ratio itself. And I've given you just a graphic here to kind of put this into perspective. You can see that the score was highest when we were carrying, below 10%. And then as we go out along this model, we start to get maxed out. You can see credit debt ratio shifts and you start to see things go down. The score begins to drop. And as we're looking to improve our score, we just take it the opposite direction. We're paying down debts, bringing things closer to 30%, and then pay off. You can see that score goes right back up. Length of credit history. So the rule here, we want to be cautious about opening and closing accounts. If you have questions about opening and closing accounts, that's why we do the webinar series. We want you to ask questions. Don't go about this in an ad hoc manner where you're opening and closing accounts. It comes with consequences. So when we think about the FICO rule, opening and closing accounts, it's going to actually affect two parts of your score. One, when you close an account, it affects your payment history. So you're going to get points deducted at that stage just from closing accounts. But you also, when you close an account, let's assume that we have 4 accounts. You close one. If you're carrying a balance on any of your other cards, it shifts your credit debt ratio. In most cases, that too will lower your score. I call it a double whammy, not a textbook term, but it certainly, we get hit from both directions, lowers our score. When you think about length of credit history, we want accounts that are open and active, longer than 7 years. We do not close. If you have any questions about length of credit history or closing those accounts, always reach out to us first, particularly when you're in the process of trying to obtain a loan. Credit inquiries itself, very easy to kind of differentiate this. If you're asking someone, the credit union, for instance, to loan you money, that's a hard inquiry. Soft inquiries are largely for education purposes, no impact to the credit score itself. You pulling your credit report, monitoring your credit score, no impact to your score. What we don't want is a series of hard inquiries where, again, thinking about risk, your score is lower, you're in the process of just applying for things kind of in a blanket form to see if you can get a line of credit, presents a very poor image as a borrower, and also is an indicator of a high-risk borrower. So we want to be cautious about that. If you're in the market for credit, again, why we're here today, ask us questions. You can always speak to a loan officer directly at the credit union or contact Trinity, and we will work directly with you and the credit union to make sure that you get the product or service that you need. The credit mix itself, here's what we're talking about. I opened earlier, again, thinking about some of those kind of theoretical concepts, if you will, revolving and installment accounts. Here, what we're talking about is, what do we have in terms of looking at the types of credit that we have? Do we have credit cards? Do we have installment loans? Do we have some mix of those? We always want to present that we have a credit mix. Most of us will have some type of mix of student loan, a car loan, a small dollar loan that we've obtained, something there. But again, in terms of segmentation, we're kind of all in different places at different times. So if you're a thin file, then we need to broaden that credit mix. If you're someone who carries a lot of credit at this point, maybe it's a credit debt ratio issue or improving your payment history. So credit mix may not be that issue for you, but as you get closer to things, higher dollar loans, home loans particularly, this factor becomes very important, having a proper credit mix to evaluate risk. So that becomes the 5 factors that make up our score. And those are the 5 factors that you will rely on as you think about answering that larger question, why is my credit score X? In the remaining time, I'll just kind of quickly walk us through here. When we're thinking about, collection accounts or debts or those sorts of things, one of the things that I want you to always focus on is that we can always take initial steps to improve our score. So we will start out by looking at things that we can kind of get back on track. If you're not in a charge-off status, maybe 30 or 60 days delinquent, we're going to get you back on track. Keep that from going into an account status. We'll prioritize your outstanding debts and come up with a plan, try to get your payment history back on track and look at ways to maximize your money and pay down debts so that we're within that credit debt ratio. Bring that back into focus if we've been maybe on the wrong track or job losses or whatever the situation may be. Our goal, though, is to reestablish positive payment history and start to diminish the debts that we have. And there's really three kind of strategies that we can take in doing this work, kind of looking at our overall score itself. This will focus on the debt side. The 5 factors that I talked about is just having you identify maybe within that model that you can improve. If you're carrying debt, these are the 3 strategies that we could use to kind of help us pay down some of our debts and improve our score. First one that we'll look at here is what we call credit utilization. I'll keep this very simple. What we're looking to do is just take our unsecured debts, that is largely credit card debts. We will rank order those from lowest to highest. And then our goal here, thinking about utilization, is to get somewhere around 30%. So if you have 5 cards, 4 cards, whatever it may be, our goal is to figure out how do we, in addition to our monthly minimums, start to diminish these debts down to about 30% and then pay off. Now, I noticed on the website, the credit union's website, that there's an education tab with calculator there. You can actually start to quantify this, where you can look at your monthly payments, the number of cards that you have, and what it would take to actually increase or accelerate loan repayment using one of the calculators. The goal here with credit utilization is getting it to 30% in totality, okay? So that's one approach. The interest rate approach is where we look at the highest to lowest interest rates and rank order those. And the idea here is we come up with a way to kind of pay down over this 6 to 24 month time frame. Again, using a calculator will save us a lot of guesswork, but the idea is that we find a way to kind of minimize our outstanding debts, looking at the approach here, looking at the highest interest rate, and then rank ordering from highest interest rate to lowest, trying to pay that down. I've noted here that one of the consequences here, if we can't accelerate quickly under this method, that it can be very fatiguing and it can burn you out. So we want to make certain that we find which one of these approaches may best work for you and the money that you have to work with in terms of paying down debts. And the last one we look at is what we call the rollover method, which again, rank orders from lowest to highest outstanding debts. And our goal here is to make monthly payments. We focus on that next card that's the highest. And what we're doing there is, let's say that we paid down $500 on a card or $1,000 on a card, and then we roll money forward to card 2, 3, and 4. We keep rolling funds forward to try to pay that down over a 24-month time frame. It can be longer if necessary, but the consequence here is that we see an efficient way to accelerate loan repayment. And that's what we refer to as the rollover method. So those 3 methods, that's a very quick overview of those 3 methods, but that focuses on the debt side. That's the credit debt ratio approach that we would take to kind of pay those debts down and see that score go back up. So if you need any additional assistance, and we're hoping this kind of just gets you interested in the topic so that we can do some further work together, always reach out to us. As I said, certainly here to help. We want to establish, products and services for you, find a line that works for you. If you need to rebuild, establish credit, or if you're just looking to improve your overall credit capacity, that's why we're here today. Give us a call and let us know how we can help you. We certainly are here to help, and there's so much work that we can do together. So that today, guys, brings us close to the end. If you are in the market right now where you need some help, we certainly want to work with you. There's a whole range of products and services that we can provide, and the nonprofit credit counseling that's here to support you along the journey. So that's what I have for you today. Again, if you need to reach me, this is the best way to reach me here at the credit union. And I just realized my camera's been off the entire time, so I apologize about that. I tried to turn it on, but it wouldn't go on. But anyway, I appreciate your time today. If there is any questions, I would be glad to help you in any way I can. But thank you so much for joining us. Jennifer, go ahead.
Thank you so much, Todd. It was wonderful information today. We hope that you found some of it useful and learned a few things about credit and how credit works. We did put a link for our next webinar in the chat, as well as that loan calculator that Todd was referring to earlier. We hope you have a great rest of your day, and thanks for joining us.